This is VeriScope News. We provide verified data and clear context for the global economy. Our reporting remains neutral and focused on the facts. Inflation data from Germany serves as the primary indicator for the health of the Eurozone. As the largest economy in the region, Germany's price stability dictates the direction of the European Central Bank's monetary policy. The December figures provide a window into how the European continent is transitioning into 2026. Understanding these numbers is essential for gauging the stability of the euro and the purchasing power of millions of households. Preliminary data from the Federal Statistics Office indicates that German inflation slowed more than expected in December. The rate dropped to 2.0% on a year-on-year basis. This is a decline from the 2.6% recorded in November. Analysts had previously forecasted a softer drop to 2.2%. Simultaneously, core inflation fell to 2.4%. This suggests that the cooling of prices is not limited to volatile sectors like energy, but is becoming embedded in the wider economy. The German economy has faced significant hurdles over the last 24 months. Following 2 years of contraction, 2025 saw a marginal growth rate of 0.2%. Chancellor Friedrich Merz introduced spending measures intended to stimulate the economy, but these require time to take effect. The current drop in inflation is partly attributed to base effects. This means the high energy prices from the previous year make current prices look lower by comparison. However, the data also shows price drops in clothing and leisure, which indicates a shift in consumer behavior during the critical holiday season. The impact on household finances is the most immediate result of this data. A 2.0% inflation rate means that the erosion of purchasing power has slowed. For families, the lower prices in food and clothing provide a necessary reprieve after years of high costs. This creates a stabilization of the monthly budget. However, because the economy remains weak, wage growth may also slow, meaning the net benefit to households is a return to a baseline rather than an increase in wealth. Regarding prices, the stability in energy is the most significant factor. Energy prices have dictated German industrial output for decades. Lower energy costs allow manufacturers to maintain margins without raising prices for consumers. This creates an environment where the price of goods remains predictable. This predictability is vital for long-term planning. For the job market, the news is mixed. Lower inflation is generally positive, but the underlying cause, weak economic growth, suggests that companies may remain hesitant to hire. If demand for goods remains low, businesses may prioritize efficiency over expansion. This leads to a stagnant labor market where job security is high for existing employees, but opportunities for new entrants are limited. Savings and investments are also affected. With inflation at 2.0%, the real interest rate on savings accounts becomes more favorable. If the European Central Bank maintains current interest rates while inflation falls, the real return on cash increases. This encourages saving over spending. For businesses, this environment requires careful navigation. The cost of borrowing remains relatively high, while the growth of sales remains low. This encourages debt reduction rather than aggressive capital expenditure. Business sectors like retail and leisure saw price drops in December. This indicates that companies had to lower prices to attract customers during the Christmas season. While this is good for the consumer, it suggests that profit margins in the service sector are under pressure. If businesses cannot maintain margins, they may reduce investment in 2026. Economists are now focusing on service sector prices. While energy and goods have cooled, the cost of services often remains sticky due to labor costs. Analysts at Commerzbank and ING suggest that inflation will fluctuate around the 2% mark throughout 2026. The key indicator will be the January data, which often includes annual price adjustments by service providers. Additionally, the Eurozone-wide inflation release will confirm if this trend is consistent across the entire currency bloc. For the viewer, this data represents a transition from a period of high volatility to a period of stagnation. The era of rapid price increases appears to be over for now. However, this does not mean that prices are returning to pre-2022 levels. They're simply rising more slowly. It is a time for conservative financial planning. The focus should be on the stability of income and the preservation of existing assets rather than expecting rapid growth in the broader economy. To understand these numbers fully, we must look at the technical nature of inflation reporting. Inflation is a measure of change over time. When we see a drop to 2.0%, it is a comparison to the same month in the previous year. If the previous year had an unusual spike, the current year will naturally look lower. This is what economists call a base effect. It is a mathematical reality that can sometimes obscure the day-to-day experience of the consumer. Even as the rate of change slows, the cumulative effect of previous inflation remains. The cost of living is significantly higher than it was 5 years ago. This context is important because it explains why people may still feel financial pressure, even when the official data shows a return to normal. Stability is the goal of the central bank, and these numbers suggest they are nearing that goal. But stability is not the same as a reduction in the cost of living. It is merely a cessation of the rapid increase. VeriScope News is committed to providing clear, context-driven reporting. We avoid speculation to ensure you have the facts required to understand the global economy. Thank you for your time.